Real estate market analysis is a tool to gather information to know if we should invest on a property or not. The objective is to be sure that the project is viable and fits in the existing market. Hi, I am Anbu, founder of Equaspaces. We are into real estate consultant. The simple truth is that the market value of your home is what a buyer is willing to pay. An estimate of your home's value is the prediction of what most buyers would be willing to pay at a given time. This prediction requires a close look at two factors: the recent home sales in your area and an assessment of real estate market. Pricing correctly is a fundamental to successful outcome in the sale of your home. So what is market analysis? A real estate market analysis is also known as comparative market analysis. It is an analysis of current market values of properties comparable to a property you are looking to buy or sell. Recent closed sales in your area offer the most relevant data for predicting the sale price of your home. Later, when your home is appraised for the buyer's loan, the appraiser will only consider the closed sales. List prices of homes on the market are of interest too, because they show the current pricing trend. If your home is superior or inferior to most homes in the neighborhood, or if there are no nearby sales, then it will be more difficult to anticipate the responses of potential buyers. In this case, a strategy of trial and error may be necessary. This strategy will require a realistic assessment of buyer's response. Sometimes the buyer's response are unrelated to the size and condition of the home. Real estate market analysis is an important part of pricing and assessment of the state of a real estate market. The market may favor seller or buyer or may be in a balance. An indicator of the quality of market is the number of months of standing inventory in your market and price range. So, the formula used to estimate these months of inventory is the current inventory divided by the rate of sale shows the number of months it will take to clear the current inventories, and it reveals the state of real estate market. And there is of two types of market, the seller's market and the buyer's market. So let's see what is the seller's market. So if the unsold inventory is less than 6 months, it is considered a seller's market. In this market, there is large number of buyers in proportion to the number of homes for sale. The demand of homes are greater than the supply. Buyers must compete with each other for homes. Sellers often receive multiple offers. Buyers will submit the highest price that the market will support. Price will tend to upward. In the climbing market, it makes sense to price slightly above the recent sales. Now let's see what is a buyer market. If the unsold inventory is more than 8 months, it is considered to be the buyer's market. In a buyer's market, the number of homes for sale is large compared to the number of buyers. This market is created by excessive construction, employment decline, or high interest rates. A low number of buyers relative to inventory results in lower price. Sellers must compete with each other for the available buyers. Prices tends downwards. In a falling market, the price should be set at a lower end of the range because the time works against you. In 6 months, prices may be lower. This may be difficult to do, especially if the home was purchased at a higher price. So, should you price your home at a high value? House should not be priced over the market. This is not the best way to position your home for several reasons. Your home will be shown to the wrong group of buyers. You will be inadvertently helped to sell the competition. Your high price will convince buyers that another home is of a good value. Your best leverage occurs during the early marketing periods. Your days on the market is evident to buyers and is suitable but important factor in their decision. So how will you correctly price a home? The second looks from the buyers is the best affirmation of current pricing. This indicates that your home appeals to buyers in your price range. There may be few nibbles before the buyer comes forward who is ready to act. It helps to get feedback from their showings. How long should you market a home at a given price? So there is no standard time frame for marketing at a given price. About 8 to 10 showings is a reasonable number to get a sense of the market response. This usually corresponds to about 2 to 6 weeks for an average home in a balanced market. About 30 days marketing time is a reasonable price test. However, this may be too short for an unusual or high-end home for which there is a small market. Or 30 days may be too long for a home if you need to move fast and there is plenty of activities. So what if the home does not sell in a reasonable time? If your home has been on the market for months with no offer, this is clear message that the price is set too high. So what do you do at this point? Whether you need to really sell? If you are not really motivated to move soon, you could wait for the market to move up to your price. It would be best to take your home off the market and wait for better conditions. Buyers are suspicious of house that has been for sale for a long time. If you need to sell, consider a suitable for dropping your price until it reaches the level that attracts the buyer. At the right price, your home will sell. So, a real estate market analysis should always be done whether you want to buy or sell a property. The seller have to do market analysis to ensure he does not overprice the home, which will lead to expired list and lose the freshness in the market. Pricing the property too low will result in losing potential profit. Thank you.